Okay, so it's the 28th today. The market just closed. This is the final week of this daily option challenge. I believe we left off on Friday. I mentioned I was bullish for Monday, and even though it was a red candle, because we started the day pretty high, went a bit higher, and then ended lower, the close is still higher than Friday's close. So the market technically did still go up. So my 810, 815 bull call went to $5 and I made $2.32. And since this black support line is continuing to go up, I'm going to remain bullish. So the market closed at 5,823 today. I'll go to October 29th and maybe buy the 25 and sell the 30.
Order filled.
And that filled at 280. So we'll see how tomorrow goes. And here we are on Tuesday. It looked like the S&P 500 did finish higher. I was anticipating it to continue going up this black line because a trend will continue until it is broken, but it's safer to assume the trend won't be broken if it already established several days respecting that trend. So the price was above the black line for a good part of the day. I'll go into the 30-minute chart so we can have a better look. Basically above the exponential moving averages, the 9 and the 21, also the 50. And it was pretty bullish until the last half hour where it dropped more than 10 points. But luckily it still finished positive at just 0.16%. If the price had continued falling to the 50 EMA, then I would not have captured all of the value with my spread. But because it did finish higher than 58.30, my bull call I put on yesterday is now worth $5, the maximum amount, and I made $217. In terms of tomorrow, there's a 61% chance of the market continuing to go higher because the price is above the green 9 EMA on the daily chart. And even though we had a big sell-off near the end of the day, the bottom wick is still longer than the top wick, meaning upward pressure. So for October 30th, I will buy and at the money 58.30, sell the 58.35, because right now the price is kind of in between those two strike prices. Yikes. No, I'm not paying that. $344. What's happening in the aftermarket? Let's take a look at the 5-minute. Okay, well that explains it. Alphabet is going crazy in after hours. So it's going to be difficult to make a trade expiring tomorrow because you can see the after hours, the S&P 500, is already up a full point. That means I'm not going to get much if I do an at-the-money call spread because the SPX now is pretty much at 58.40, even though it finished down here at 32. So even if I do like a 40.45 spread, it's still really expensive. So maybe I'll just sell a put instead at maybe 40.35.
Order filled.
Okay, it's not going to be much, and we have that one there. So we'll see how things turn out tomorrow. All right, it is Wednesday, my dudes. The market hasn't closed yet. There's a little over an hour left, and it looks like my bull put at 58.35, 58.40, so I want the market to close above this line. It's probably not going to happen. The market will close at this gray bar over here, and we're quite a bit below that. Because I sold this at such a cheap price, $156, I think I'll just get out of the position now and lose like $250 instead of waiting till the end of the day, risking the price to not go much higher, and then losing $350. So I'm going to close the 35.40 put.
Order filled.
And that filled at 385. So even though I took a loss there, about $230, it's better than a $350 loss. Because even though the morning felt pretty bullish, the market seems like it just does not want to go above 21 EMA, the blue line, on the 5-minute time scale. And currently the 21 EMA is sitting at 58.32, so that's below the 35 short put that I had. So we'll count this one as a loss, and we'll just wait another hour until the market closes, and I'll put in another trade for tomorrow. Okay, it's the end of the trading session. Markets just closed, and indeed, the S&P 500 continued to go down, so good thing I got out of my position early. Because of how the market closed today, a red candle, and the price is below the 9 EMA, this green line, I'm leaning towards bearish. I'll be buying an at-the-money put spread, 58.13, so maybe I'll go 58.15, and then I will sell the 58.10, and this means I will pay about $210. Let's see if that fills.
Order filled.
There we go. So it filled at 205. So based on how the market is looking, I think it will likely continue to go lower tomorrow. So let's see on Thursday what happens. Okay, today's Thursday. The market just closed. Last trading session of the month, and we had a big red day. Must be all the Halloween bears coming out. In terms of yesterday's trade, there's my bear put spread, 58, 15, and 10. I paid 208, and basically that finished at $5, so I made $292, which now takes the total to 209. In terms of tomorrow, I think we're going to have an up day to try to maybe fill this gap. If it doesn't bounce that high, then it might finish somewhere in the range of today's candle. Looking at tomorrow's prices, around 57.05. I can buy this call and sell this one.
Order filled.
And that filled at 280. So even if the market goes up just a little bit tomorrow, I should be able to make about 220 from that. So let's see what happens. Okay, last day for this week. Also, the October stats have now finished. Yesterday on the 31st, I mentioned it likely will go up and most likely either try to fill this gap or at least close somewhere between the top and bottom of this red candle. It looks like the market tried to go up, got rejected before the high of yesterday, and then came back down, but ultimately still finished positive. So that bull call that I made yesterday expiring today is at full value, $5, and I made $217, which means for the month of October, I was up 13 times, just betting on if the market would go higher or lower. And 10 days I was wrong. Ultimately, together, that's 23 trading days in October, with yesterday, October 31st, wrapping up the month. And overall for this challenge, I made $426. Like I mentioned in the update before this one, it is kind of disappointing how my win rate is not like it should be on paper. Even with the 13 wins out of 23 total, that's a win rate of 56%, which is lower than the 60 to 65% I was expecting, but a positive return is still better than a loss. In terms of this new month in November, I'll probably do something similar, but I do want to change things up a bit and fine-tune my method to increase my chances of more success. So I'm going to make a couple of changes. The first one has to do with the inherent bias in the market. On certain days, the market is already pricing in a higher open the next day or a lower open. And when that happens, it can skew the prices in the options market. And when you see these days where I am down like $268 or when I'm only up like 217, that's the issue because then the odds are not 50-50 where I will lose 250 if I'm wrong, but I gain 250 if I'm right. In these cases, I lose more money if I'm wrong and I make less money if I'm right. And that's because if I think the market's going to go up from my estimate the next day, let's say, and the market also anticipates that, then my bull call is going to be very expensive. So when the next day comes and the trading session is over, it was indeed up, I'm not going to make as much as I would like because I've already overpaid for my option spread. So the most I can get is like 220 or something. So to remedy that and to get to more of like a 250 even split, I'm going to change my strike prices. In this case, I would just choose a higher strike spread. So if I do earn the entire amount, then this would be more like 250. Same thing with the losses. If I'm wrong, then it will be minus more close to 250 instead of like 260 or 270. Now, the downside of that is, of course, then the market would have to move a little bit more in the direction that I want. So for example, this October 24th, if I put the trade in at the end of the day, betting the market would go down, even though the next day on the 25th it did go down, but I might not make money if I use this new method because it only went down like a few points. But at least this way it'll more accurately represent my win-loss ratio. Because if I win 3 times more than I lose, then technically this total amount earned for the month should be closer to 750 if each win nets around 250. So adjusting the strike price to accommodate a more even profit loss ratio should help to not have like big down days. Like the second day I lost 288 and then this day I lost 283. It's harder to come back from those bigger losses rather than if they were just 250. That's the first thing. The second thing I'm going to do differently is to avoid situations like this where a company releases earnings after market closes, in this case Alphabet, and we see this huge spike up from around 170 to 180. In this case, because Alphabet is such a large part of the S&P 500, you can see what it did to the stock market index. This is the SPY. Market closed down here, and in after hours trading, because of Alphabet's earnings beat, the S&P 500 went up 1.29 points, or 0.2%, which is a pretty big move for after hours. And this affects the options price, of course, because if I'm bullish going into the next day and the market does this before I put in my trade, then again, I'm going to overpay since the market is anticipating prices to gap higher the next day. And the problem with overpaying is even if you're right, you won't make as much money as I mentioned before. But if we actually take a look at what happened during that time, this is the SPY on the 5-minute chart. Here we can see it closed at 581. Alphabet released earnings. It was very bullish, and then the entire market started heading up in after hours. But then the next day, in pre-market trading, which is this yellow highlighted area, things started to go down. And ultimately, we closed the day lower than before. So the market bought into the earnings, and then they dumped it the next day. And because I overpaid for the initial bullish trade on the 29th, I would have lost a lot more money on the 30th when things didn't go as expected. But like I said earlier in the video, I did get out of this position. So instead of losing over $300, I lost around $230 instead. So in order to get around this problem of earnings ruining the options pricing, I am now going to be placing my trade right away at market close, which is like 1 p.m. Western or 4 p.m. Eastern, instead of waiting like 5 or 6 minutes to do my calculations. So what that means is I'll have to conduct my analysis before the market closes instead of at market closing, because as soon as the market closes, I'm going to put in my trade so that if the market moves in after hours, it's not going to affect the initial price that I'm going to pay for the option spread. In terms of Monday, November 4th, I do expect markets to go up, and that's why you see this November 4th, 57.30, 57.35 bull call. So that's it for the update. I'll continue on this challenge for November and see if the result is any different with my new changes.